And welcome into your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment retirement future. He is president and founder of McIntire Retirement Services, home of your game plan for retirement. Chris McIntire here. Always a pleasure having you on the program, Chris, laying out the game plan for us. And certainly during the midst of chaos, of volatility, is where it becomes more important that we have that plan in place to help guide us financially.
Yeah, absolutely, buddy. And, our tip of the week here is that, short-term volatility is not the same as long-term decline. So, what we're experiencing right now, we're all hoping it's short-term volatility with the price of oil and the Strait of Hormuz and whatnot, as opposed to, 2000, 2001, and 2002, where we had significant declines over about a 2.5 year period. So, Russia invades Ukraine, okay, and that was short-term volatility. And 5 years later, Russia and Ukraine are still fighting just like they were. But, the market had an initial shock. And then look what happened. Same thing with the tariffs last year. Short-term volatility, market closes at record highs. And just recently, the market has had recovered to almost the record highs as well.
Yeah, well, you turn on the news, Chris, and it sure feels uneasy for investors. But then you look at the market, and it is in a stone's throw of those all-time highs, as you said, while we record this program here. So this is nothing new. This is nothing unusual. This is not something that investors have not navigated before. But every time we see this short-term volatility, I think that there's a lot of emotional reacting from investors that ends up costing them a good deal of money.
It sure does. Emotional investing, it can be challenging. And, hey, we're all human beings here. And, when you watch your portfolio decline 7 to 10 to 15%, depending on how much risk you're taking, boy, it can certainly make it, do a gut reaction. And, let's give the analogy this way. So let's say you had $1 million invested and the market fell by 4%. Well, most people think, well, 4% isn't that much, All right, well, that's $40,000 that your portfolio would have gone down in value. And notice I didn't say you lost. Your portfolio went down in value. If you sold that day, then you would lose. But, 4% doesn't sound like much, but 40,000 sure as heck does.
Yeah. Well, have you ever seen the movie The Princess Bride?
I have not. It sounds like a chick flick, so I'm out.
No, it's a classic movie, Chris. You've got to check it out. But at one point in time, the main character, Wesley, gets taken down into the pit of despair, where there's this torture device that sucks years of his life away. And every time I see the market go down 4 or 5%, I'm like, it just sucked 2 years of my life away. The progress that I've made financially. And I think of Wesley down there in the pit of despair and everything that he went through there in the movie. Anyway, ladies and gentlemen, Princess Bride reference here to start your game plan for retirement on today's program. But if you've got questions, if you've got concerns about years of your life getting sucked away or not, and you want to make sure that it does not happen, pick up the phone, give a call to McIntire Retirement Services. Chris McIntire puts together that game plan for retirement, your game plan for retirement, a personalized plan with diversified strategies, long-term vision of your goals, and working to help you achieve them. No cost, no obligation. It's a courtesy service for being a listener to or viewer of the program. 419-332-0532. 419-332-0532. 419-332-0532. So to start this off from a high level, Chris, we're talking about, the news headlines and the reaction that the market has. Now, headline news and global uncertainty are an ever-present factor. It's not like these headlines go away and then we're going to all be kumbaya and there's not going to be a next headline to drive uncertainty and fear and worry and market volatility.
Yeah, we talk about war in the Middle East. Okay, well, when has there not been war in the Middle East? And not making light of it by any means, but it's certainly been a hot spot. And the U.S. came in I think with our military power, this was certainly a different type of conflict. It wasn't boots on the ground. We're seeing drone warfare, whatnot, and that kind of ties into, aerospace and defense. That's been a pretty hot sector to start off 2020. Six as an example. And Peter, I was making a trade buying some aerospace and defense when, waiting to join the radio show here with you, buddy.
Yeah, so Chris, with a plan in place, I mean, just from your example here, not panicking, looking for the elements of opportunity amongst the chaos, I think is one of the strategies that we'll talk about today.
Yeah, absolutely. And, again, we've said this so many times, look, you might be a moderate in type of investor. So you like 60% stocks, 40% bonds, something that's our kind of rule of thumb, if you will. Okay. And all right, of the 60% in stocks, what type do you want to own? Do you want to own, the good quality dividend payers that typically are going to hold up a little bit better in times of volatility, but they're also going to lag behind, when the market runs up, right? Those big quality companies aren't necessarily driving the AI innovation. That'd be more the tech sector, obviously. And, that's certainly going to continue on. The AI spending has certainly ramped up even more. I just saw where you read this morning, I think it was on the Bloomberg website to give a reference, that utility companies are going to spend like $1.4 trillion to begin to create even more electricity to drive this data center demand. And, and then we're seeing other places where, like I think it was in the state of Maine, they put a restriction on data center development. And, it's that, what is it? NIMB, not in my backyard. Everybody
Yep.
wants the conveniences, but doesn't want to have to drive by them. And I know where you're at, Peter. You probably have a lot of them. We have them around here as
Two
well.
two towns just put moratoriums on them right here in my backyard, though, Chris. Yep.
Okay, yep.
Yep.
And and they're wanting to be careful without driving up the cost of electricity for us consumers to pay for these huge corporations to, drive that demand for the artificial intelligence. That will be a part of everyone's life if it isn't already.
Well, the infrastructure's got to be there. The power, the facilities, all of that, the raw materials to put them together. So there's a lot of ancillary impacts, ripple effects, if you will. When one sector of the economy moves in a certain direction, there are going to be others that have to fill in as well. And that's why we see, hey, a conflict in the Middle East, okay, defense, aerospace, things like that might be the opportunities amid the chaos. Energy, oil, all of those things are going to continue to be utilities, like you said, Chris. So we can, and here's the most important part, I think, though, if we have the guide star of a plan, if we've got the game plan for retirement laid out, Chris, where we know we've got some money that is there for us dependably, reliably, but also have identified our opportunity money, we can look for those opportunities when others might be panicking. And I think that's the key to long-term investment success.
Yeah, exactly. And and Peter, it's fair to tell our listeners, we're not talking about day trading, right? We're
Right.
talking about adding some positions to take advantage of some of the other sectors. For example, the Nvidias of the world were running wild there for years, and then all of a sudden, at the end of last year, the market started to spread itself out across value stocks, dividend-paying stocks, and we saw them outpace the growth stocks, if you will. So that's what we mean by that. As the economy ebbs and flows, there are different areas of it that certainly can outperform other pieces of it. There's 11 sectors in the S&P 500. So, sometimes it's the tech sector, sometimes it's the consumer staples, the Walmarts, the Procter and Gambles, especially in times of volatility. That's where investors go, is for safety. They might move out of high risk bonds and move into more like government bonds for that inherent safety there. And they will take some less returns for that, to have the peace of mind that, all right, now may be the time to play a little more defense than we had been playing. Probably a good analogy.
Well, again, we are talking with Chris McIntire, president and founder of McIntire Retirement Services. If you'd like to get your game plan for retirement put together, pick up the phone, give a call, 419-332-0532, 419-332-0532. And it's not just the Middle East, Chris. It is geopolitical uncertainty and tensions, interest rate environment. We had expectations that interest rates would be falling. Now they are not falling as quickly. The slowing economic growth, inflation still remaining stubborn. With all of this, when investors react emotionally to market volatility, it might not be the market volatility that is the danger here, Chris. It might be the reaction itself that ends up causing and creating more damage for the individual investor.
Yeah, good analogy right there. Yeah, it certainly can be. And, we'll get phone calls from time to time from nervous clients, nervous investors that say, hey, I just want to get out of the market for now. We'll look back at it later. I'm like, what, after it rebounds 15%, that's when you want to get back in. And, you've got our job as advisors is to help educate the clients as to look what is going on in your portfolio. Yep, you may have some ebbs and flows, but for most of our clients, Peter, that we have safe money strategies in place for them, so that if something goes on in the portfolio and it goes down a little more than what we want it to, that we can shift strategies, pull some money out of the safe part of the portfolio and let the risk part of the portfolio give it time to recover, take pressure off of it, especially when money's coming out of it. When you're still working, for those of you that are out there that are still working, you may have some of your portfolio, your 401k, much more conservatively invested because you're coming up on retirement. That makes a lot of sense. But maybe your contributions could go into equities, when the market goes down and, you're buying low, selling high, so to speak, kind of like what Warren Buffett would do. And it seemed to have worked out well for him.
Yeah, well, asking the reliable AI here, Chris, what are some of the biggest mistakes investors can make during volatile periods? And just a few of them: selling investments after declines, moving to cash at the wrong time, abandoning long-term strategies, trying to wait until things feel better to get into the market. So just a few of these mistakes that really center and circle around emotional reaction rather than long-term vision and discipline planning in your investment portfolio, Chris.
Yes, yep, without a doubt, that's the long-term success is, trying to check that emotion at the door, let logic take over. I think that's probably why engineers are so successful at what they do. They don't make the emotional decisions. They look at laws and statistics and things like that and what happens over the long haul. What's the return on the S&P 500 over its existence? 10, 11% plus or minus dividends in there, and that's a heck of a lot better than what any CD's done for you for the last 25 years. Not that it doesn't make sense to have safe money. I have safe money, Peter has safe money as well, but it's not the bulk of our positions there. And when you're in retirement, it certainly is going to look a lot different. Because you've already, we often say offense wins games, defense wins championships. So you played offense while you were working, and then in the end here, now that you want to get across the goal line, through your retirement, having some defense certainly is going to make a lot of sense. And Peter and I are big hockey fans, so the Stanley Cup playoffs are just getting ready to start right now, and unfortunately the Red Wings aren't in there, but Peter's Carolina Hurricanes are, and they're my team I'm pulling for in the East.
For
But
the eighth year straight, Chris,
for the eighth year straight, don't rub
and,
it.
and 8 years without a Stanley Cup. So, how you finish the regular season, if the ultimate goal is bringing that cup home, we've been almost there a few times.
Yep, absolutely. And and they say the teams with the hot goaltender have the best chance of getting there. So that's the defensive side. We all just watched the Masters here recently, and Rory got out to a pretty good lead there, and was able to stumble a little bit down the end, hung in there, and played basically par golf and won the championship. He didn't have to take all those risky shots and whatnot. So tying this into a number of different sports.
Well, I'm gonna pull another audible here, Chris, on your game plan for retirement. Because we just wrapped up tax season, and we're talking here about market volatility. I think that perhaps helping people to understand the opportunity that is currently present in our tax environment may be an easier and less emotional financial opportunity to identify. And I know that as a self-proclaimed tax geek that you have said to be, that you help a lot of people with their tax strategies and identifying those opportunities. Is that something that you are talking to a lot of people about right now?
Yeah, without a doubt. We recently, have been talking with some folks, and their whole goal was to avoid taxation. I'm like, well, the avoiding taxation is hard to do with $800,000 in an IRA account. You can delay taxation, but you cannot avoid it. You have to, help mitigate it. So you want to pay the least amount of tax that you possibly can. We can help that through Roth conversions, the right type and size of distributions that you take out, the timing of your Social Security and pension benefits. And if you have money outside of an IRA account, how do we mitigate spinning off a lot of capital gains and a lot of dividends, a lot of interest income, so that we're not driving up your tax bill on money you're not spending.
Tax management, proactive tax strategies. Would you put that in the defensive playbook, Chris?
I suppose you could. It depends on at what point you are in life. If you're in retirement, definitely. And you and I aren't retired yet, but tax strategies are very important to us. How we maximize 401k contributions, get the catch up. Peter's not 50 yet, so he doesn't get all those catch up contributions. He's getting there,
I'm
though.
getting there, Chris. Yeah, looking forward to the day I can put a little bit of extra money away. But and that is a great opportunity, right? If you feel a little bit behind, the kids may be out of the house by that point in time. You've got a little discretionary cash flow. Really, a great opportunity to supercharge your retirement readiness, making those catch-up contributions. Which, by the way, Chris, new law this year: higher income earners over 145,000 have to make those catch-up contributions in the 401k on the Roth side. So a lot more companies now, de facto requirement, have to offer the Roth option inside of the 401k.
Yeah, yeah, and myself included, and you as well, Peter. We both have 401ks, and my catch-up contribution has to go in my Roth, which means I can't deduct it, but at least I can put it into a Roth. And most of us that own businesses and all that, we don't have Roth IRA contributions available, so we have to have a Roth 401k to get around some of those income limitations.
IRS figured out the math on these things a long time ago, Chris. I feel like.
Yeah, and yep, and as we're still a little close to the tax filing deadline there, Peter, I'm gonna not dump any
Picking a
salt on
scab, huh?
anyone.
Yeah, there you go. All right. Again, ladies and gentlemen, talking with Chris McIntire. We're talking today about the state of the market volatility, current events, and that staying disciplined during uncertain times is what prevents unnecessary losses, is what gives you the opportunity for identifying more advantageous opportunities in and with your money. And if you don't have a plan, that becomes cloudy and murky, and you might not be able to as readily identify those. So you need to have that game plan for retirement, your personal financial and retirement playbook, customized, personalized to you, your goals in mind, long-term vision, strategy, time horizon, diversified strategies for how to get you there. And if you would like to get that put together, or just review and evaluate and double check your current portfolio, pick up the phone, give McIntire Retirement Services a call, 419-332-0532, 419-332-0532. But just again, Chris, as a reminder, we've been here before, and putting today's market in perspective, as of the recording of today's show, like, we are within a stone's throw of all-time highs on the S&P 500 index, despite this recent volatility.
Yeah, absolutely. And, the longer this conflict goes on, Peter, we may have some continued volatility, high gas prices, and Americans vote with their wallet. I think it was Bill Clinton that said it's the economy, stupid. And I bring that up because, look, we're going to be going into midterm elections later on this year. And typically you get a reversal from the party in power. So, would look like maybe the Democrats will get control of the House, possibly the Senate, depending on all the outcome. Recently they're starting to expel members of Congress for bad behavior, thankfully. And, so
They
we're
still get
draining.
those pensions though, Chris.
Oh, yeah. Yep. Yep. Draining that swamp and spend it well, Mr. Swalwell, on your way out. Yep.
Yeah.
We won't miss you.
Yeah.
Um, yeah.
The swamp of Washington is
Yeah.
been and has been and will remain a swamp, I feel like, unless we do something to change it. It seems like we don't, though. Volatility, Chris, part of the strategy. That is something that we understand as we align somebody's investment portfolio, that volatility will happen. And if you are nervous about it, if an individual is nervous about this volatility, it's not an indication of the market. It's an indication of their exposure to it, Chris. That is probably a strong indicator that they need to evaluate their risk and market exposure level.
Yes, and as we have our meetings with clients on an ongoing process, we have some special reporting that we do that say, look, given the volatility, this is what has happened to the account value, but here's the dividends and interest that came in the meantime. Then some of that gets paid out for income for certain clients, some of that gets reinvested. So, it's like, you had $4,000 this month come in dividends and interest that got reinvested while the market was down low. Those are your future rates of higher rates of return, taking advantage of, those continuing contribution or reinvestment of dividends. And, that helps take the emotion out of it. We're adding logic and removing emotion ideally.
Again, we're talking with Chris McIntire, president and founder of McIntire Retirement Services, helping put together your game plan for retirement. Chris, uh, as we are moving through the transition in the different phases, maybe from accumulation to more of goals of preservation, protection, or even creating income, distribution, and withdrawals from our accounts, are there any specific defensive positioning strategies that you talk over with your clients and proactive investors that come to talk to you, as far as consideration for more defensive positioning as part of an investment portfolio?
Yeah, without a doubt, and even for our riskier type of investing clients, we still talk about the inclusion of a safe money strategy so that they don't have to alter their lifestyle on their risk portfolio. So that's very important. And, we'll go through what are all of our options for, kind of that safe and secure positions in the portfolio from, money markets, CDs, fixed annuities, fixed index annuities that are very safe. And, a lot of those don't have the management fee structure that the investment portfolio does as well. So some clients, we kind of help utilize that to, mitigate the overall cost of managing a portfolio also.
Diversification, Chris, tried and true, rebalancing. Are these still things that people need to be cognizant and aware of, or is that sort of part and parcel for what most people are doing?
Oh yeah, rebalancing very important. And what Peter means by that is, let's say you have a 60% stock portfolio, 40% bond portfolio, and you had a 1 quarter, for example, where the market bounced up significantly. Now at the end of the next quarter, you might have a 70-30 portfolio. So if you rebalance, you're going to take some of those gains off those stocks and move them over into your bond portfolio. That will help insulate that portfolio from when the market goes down significantly. You've already repositioned. So you're also keeping within your overall risk profile as well.
At what point, Chris, does rebalancing become counterproductive? Like we want to take advantage of the growth of the market over a period of time, but is there a difference between quarterly, semi-annually, or do people try to rebalance on a weekly basis and basically do more harm than good?
Yeah, if you do it too often, you're doing a little bit more harm than good. So, 3 to 4 times a year, very common in the rebalancing side of things. And, for those of people that have those retirement lifestyle funds, they are rebalancing them as the calendar turns, not necessarily based off of the economics, but just because of the calendar. And, sometimes if the market's running strong, hey, there are times where you say, look, I'm just going to get out of the way of this thing right now. And, I'm going to look at it next month,
Yeah.
but,
Well,
and in the current economic environment, I mean, one day the price of oil is $120 a barrel, the next day it's 90. So, I mean, these are some, pretty unusual times, if you will. I mean, with just the way equities move, and everybody's got an
but
iPhone.
isn't every time kind of unusual? I feel like there's this moment every year, at least every 5 years or so, where it's an unusual time, right, Chris?
Yeah, yeah, without a doubt, we run into that, and with having President Trump in office, he brings a business mentality where we're going to get things done and get them done expediently instead of most of us are used to politicians and kind of a bureaucratic process that's long and drawn out. Now we have a kind of a corporate business titan in there that wants to get things done and get them done immediately. And, sometimes that's met with a lot of resistance, obviously, even within your own party, not to mention the opposite, the opposition.
Well, again, asking the old AI, what is to an investor's advantage during times of volatility? Long-term thinking, investing, Chris, should be a 10-year time perspective, not a 10-day time perspective. So the big takeaway, don't let short-term noise derail long-term success. And that's what you help your investor clients and candidates to design and understand by putting together their game plan for retirement.
Yeah, absolutely. Sit down, have a discussion from the 30,000 foot level if we haven't met you before. And then a lot of times we'll have another discussion after that, within 2 to 3 weeks, and start to refine this process, maybe run some illustrations on our software for Social Security for the overall retirement planning, including distributions, and then look at what are all the options to make that happen. What does it cost? And, do we need to complete some paperwork eventually? So a lot of times a 3 to 4 meeting process for us before we're ready to, do the onboarding process.
Well, again, ladies and gentlemen, if you'd like to start with just a conversation, no pressure, no obligation, no cost, pick up the phone, give Chris McIntire and McIntire Retirement Services a call. They do extend the offer and the opportunity to help you put together your game plan for retirement, extending beyond that initial conversation. And if you'd like to take them up again on that offer, that valuable opportunity, it just starts with a phone call and a quick chat and conversation. 419-332-0532, 419-332-0532. Specifically, if you'd like your investments to align with your comfort level, if you'd like to understand your risk tolerance and risk exposure, if you'd like a plan to generate more income dependably, reliably, and controlled and pay less in taxes throughout retirement, that's what your game plan for retirement is all about. Understand the risks that you're taking, the fees that you're paying, the taxes that you'll be liable for, the income that you can count and depend on. That is what you will walk away with after having that game plan for retirement designed for you, along with you. 419-332-0532, 419-332-0532, 419-332-0532. Chris, we always appreciate your guidance here on your game plan for retirement.
Hey, my pleasure. Good to be with everybody. Take care, stay safe, and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.